Agency. Part A. Discuss the nature of the principal-agent relationship in the context of governance. In company governance, when the shareholders of a company are not the same people managing the company, there is what is referred to as a principal-agent relationship. An inherent conflict of interest is created as both parties have different expectations and power over the company. The shareholder, as in the principal, appoints the director, as in the agent, to run and manage the business on their behalf. The agency theory is, therefore, a pillar of governance due to the power that directors hold within the company. The directors are also sometimes referred to as the stewards of the assets of the company. Part B. Analyse the issues connected with the separation of ownership and control over organisation activity. In theory, the directors would always operate for the best interests of the shareholders in mind, but in practice it is very easy to uncover the many conflicts of interests that may arise and break that trust. For example, the shareholders are primarily concerned with long-term share value appreciation, sometimes at the expense of short-term profits, while the directors may be paid and rewarded on short-term profits for the current or subsequent year with an exit plan in mind. Shareholders expect the highest dividends, while the agents must keep the cash of the company in order to reinvest it. Directors seek the highest bonus, while shareholders expect higher profits. Unfortunately, principals require agents as they cannot run their business themselves. Think about huge companies with thousands of employees and shareholders. These companies need multiple executive directors to be run and managed, and these directors are employees of said company, creating the agency problem. Fortunately for principals, there are systems in place to monitor the agent's performance. Non-executive directors can be appointed, which will provide an unbiased contribution, and committees can be formed. There are solutions to the agency problem for principals. The shareholders can remove directors at their will, but it may take time as a vote must be held, and some companies' shareholders can be made up of thousands of small shareholders, for example publicly traded companies. These events will incur costs to the company, often referred to as agency costs.